This video will provide a walkthrough to the solution for exercise 419, which focuses on an unprofitable long-term construction contract. Here's the data for our problem. So on February 1st, 2025, Sterling Structures signs a $3.5 million contract to construct an office and warehouse for a small wholesale company. The project was originally expected to be completed in 2 years, but difficulty in hiring a pool of workers extended the completion date by an extra year. In addition, significant increases in the price of steel in the second year resulted in cost overruns on the project. Now, Sterling was able to negotiate a partial recovery of these costs, and the total contract value was adjusted to $3.8 million in the second year. And here's some additional information for the project for each of the 3 years. So we have a total contract value of $3.5 million in 2025, and we see that it increases to $3.8 million in 2026. We have accumulated costs to date of $800,000, $2.4 million, and $3.9 million in each of the 3 years. Now, it's important to note that some questions may present this a bit differently. You may see it presented instead as costs incurred during the year instead of costs to date. So it would look like this: $800,000 in the first year, but in 2026, the costs in that year would be $1.6 million, which is the difference between $2.4 million in 2026 and $800,000 in 2025. And for 2027, the costs incurred during the year would be $1.5 million, which is $3.9 million in 2027 accumulated, minus the accumulated $2.4 million in 2026. So you want to make sure that you're comfortable working with a question that can be presented either of the two ways. And it's very important that you read the question carefully to determine how the question is structured. Then we have estimated cost to complete the project of $2.1 million in 2025, and then $1.6 million in 2026. And then we have customer billings to date and cash collections to date. Again, that could also be presented as customer billings in the year and cash collected in the year. So again, make sure that you read the questions very carefully to confirm how the information is presented so you don't make any mistakes. We have 2 requirements here. The first is to calculate the amount of gross profit to be recognized each year using the percentage of completion method, and to prepare all of the required journal entries for 2026. So let's work on solving this problem. Now, quite often students find long-term construction contract questions overwhelming because when they see the solution, it looks like there's so much going on. So let's take it slowly step by step and start with 2025. So the first thing we want to do is identify the costs to date, which are $800,000 in 2025. And then we want to pull from the data the estimated cost to complete, which is $2.1 million. When we add those two together, this gives us the total estimated costs to complete the project. So at this point, $2.9 million. Now we need to know what the total estimated costs are to determine the percentage of completion at this point by taking the costs to date of $800,000 and divided by the $2.9 million estimated cost to complete. That's 27.59%. You should round your numbers to at least 2 decimal places to avoid material rounding errors. Now we bring in the contract price, which is $3.5 million in 2025. Now what we want to do is determine what the revenue to date is based on the percentage of completion. So what we do is we take the total contract price of $3.5 million and multiply it by the 27.59% complete. This gives us revenue to date in 2025 of $965,650. Then what we do is we would subtract any previously recognized revenue. Now, because this is the first year, we don't have to worry about that because there isn't any, which means that the total revenue to recognize in 2025 is $965,650. Now what we do is we subtract the costs incurred in the year, which are $800,000, and that gives us a gross profit of $165,650 in the year. Now let's work on 2026. We start with the cost to date, this time $2.4 million. The estimated cost to complete as provided in the data is $1.6 million, giving us total estimated costs of $4.8 million. The percentage complete at this point is $2.4 million divided by $4 million, which is 60%. Now we bring in the contract price, which has increased from $3.5 million to $3.8 million because of the problems with the project. If we take that $3.8 million times 60%, the revenue that we should recognize to date is $2.28 million. Then we subtract the $965,650 that we recognized in 2025, resulting in revenue to recognize in 2026 of $1,314,350. We subtract the costs in the year of $1.6 million, which is the difference between the cost to date of $2.4 million and $800,000. That results in a loss on the contract of $285,650. This contract is now at a loss because the costs are expected to be $4 million and the contract price that we were able to negotiate is only $3.8 million. We have to factor in the additional loss on the expected work that hasn't been completed yet. We would take the total contract costs of $4 million and subtract the contract price of $3.8 million and multiply that by 40%, which is the incomplete part of the contract. 100% minus the 60% completed to date is 40%. So that results in an additional loss of $80,000, which we have to recognize in the year. So that results in an adjusted loss for the year of $365,650. Now let's go to 2027. The company was lucky enough to be able to mitigate its costs somewhat from the expected $4 million to result in a total cost on the contract of $3.9 million. The contract is finished in 2027, so there are no additional costs to complete, which means the total cost on the project is $3.9 million. The project is 100% complete. Therefore, the total contract revenue that we could earn to date is the contract price of $3.8 million. We then subtract the previously recognized revenue of $2.28 million, and that results in revenue to be recognized in the year of $1,520,000. We subtract the costs incurred in the year, which is the difference between the $3.9 million in 2027 minus $2.4 million in 2026. So that's $1.5 million. This results in gross profit on the contract of $20,000. Now, because we were able to mitigate some of those costs, we can recover the additional $80,000 loss that was recognized in 2026 to result in adjusted gross profit for the year of $100,000. Now we can also double check our work to make sure that we've done all this correctly. If by the end of the contract, the total contract price is $3.8 million and the total actual costs incurred of $3.9 million, that results in a total loss on the contract of $100,000. What we can do is track our cumulative profit and loss each year to see if we end up with a cumulative profit or loss that matches what the actual profit or loss as I just calculated. So for 2025, the cumulative profit is only the first year, $165,650. Then in 2026, the cumulative loss is the 2025 profit of $165,650 less the total loss in 2026 of $365,650. So by the end of 2026, the cumulative loss is $200,000. And then for 2027, we would add the gross profit of $100,000 to the cumulative loss at the end of 2026 of $200,000 to result in a final cumulative loss of $100,000, which matches the difference between the contract price and the total cost. So we know we've done this correctly. Now let's take a look at the journal entries. The requirement is to do the journal entries for 2026, but let's do them for all 3 years because this is a bit more of a complicated question. So for 2025, let's start with the recording of the costs. So we would debit a construction in progress account or a contract asset/liability account for $800,000. We would credit materials, accounts payable, cash, salaries payable, etc. for $800,000. Then we record the billings on the contract and the accounts receivable. So we'll debit accounts receivable for $1 million and credit a billings on construction account of $1 million. Then we record collections, so we'll debit cash of $1 million and credit accounts receivable for $1 million. This is all based on the data as presented. The last entry is a key one. So here we'll record the construction expenses of $800,000. This is an expense account, whereas the $800,000 in the first entry is a construction in progress account, which is actually an asset account. So we debit construction expenses for $800,000. Now I'll leave a space and then record the credit to the revenue because that's an item that we calculated. So we'll credit the revenue for $965,650 for the work that we did. And then the difference between those two is the gross profit. So $965,650 minus construction expenses of $800 is gross profit of $165,650, which is in the work that we did. And we'll debit this to the construction in progress account, or we could use a contract asset liability account. So what happens is we accumulate in the construction in progress account the costs plus the gross profit. And the costs and the gross profit will always equal the revenue. You can see at the same time here, I'm showing the two T accounts that are relevant to this, and these are both asset accounts. So we have the construction in progress, and the billings is actually a contra account to the construction in progress. Now for 2026, which was what we were actually asked to do, we'll debit the construction in progress and credit the materials for $1.6 million in costs. We'll debit accounts receivable and billings on construction for the billings in the period of $1.1 million. We'll debit cash and accounts receivable for $1.1 million, which is the collections during the year. Then, for the last entry, for the construction expenses, we have the $1.6 million that were actually incurred, but we also have to make sure that we add to that the loss of $80,000 that we determined we have to recognize in the year on the uncompleted portion of the contract. So the total expenses ends up being $1.68 million. If we credit the revenue as calculated to be $1,314,350, the difference between those two now is a credit to the construction in progress for $365,650, which happens to be the loss that we have to record in 2026. But notice in our T account, we have the costs of $1.6 million, and that additional $80,000 loss is captured in the adjusted loss that we have to record in 2026. Now for 2027, we have the construction in progress account and the materials debited and credited each for $1.5 million for the costs incurred in the year. We have the billings to the customers, so debit accounts receivable and credit the billings for $1.7 million. We have collections of $1.7 million, so debit cash, credit accounts receivable. And then for the final entry, we'll debit the construction expenses for $1,420,000, calculated as $1.5 million, less the $80,000 we were able to recover in the period. Because of the cost savings, the company was able to realize to avoid the larger loss. We'll credit the revenue for $1.52 million as calculated, and the difference between those two is $100,000, which is the gross profit on the contract in the year, as we previously calculated. And we can see in our T accounts here that when we factor in all of our entries, the balance in the construction progress account is $3.8 million on the debit side, and the billings is also $3.8 million, but it's a credit. Now that the contract is complete, we would eliminate those balances with a journal entry that will credit the construction in progress and debit the billings on construction for $3.8 million, resulting in an ending balance of $0. And this would no longer appear on the balance sheet. As I said before, alternatively, instead of debiting construction in progress and crediting the billings, we could use a single contract asset liability account. And all we would do here, in essence, is merge the two accounts. And if you study this carefully, you'll notice that by the end, we have a balance of $0, which means that there is no final entry necessary to remove the balances from the construction in progress and billings account, because all those entries are recorded into a single account. And that's it. We've solved the problem.